Hi, I'm Guy Miles, founder here at Flying Colours. In today's video, I want to talk about how major geopolitical events affect the way we think about investing. You know how it works. News headlines on dramatic events like wars and sanctions grab our attention and we tend to react immediately, perhaps thinking, what should I do with my investments? But here's the thing, this focus can actually cause us to miss the bigger picture. I'm talking about the broader, more gradual shifts and the systemic changes that we tend to underestimate when it comes to long-term performance. We're naturally drawn to immediate dramatic threats because once in our evolution they pose genuine threats to our survival. In investing, this translates to overreacting to vivid headlines while we ignore the steady compounding forces that have made more lasting impacts on markets. The fact is that despite all the noise from major global events, markets have repeatedly shown us just how resilient they are. This graph shows that over the past 40 years, markets have continued to rise even when facing significant geopolitical disruptions. Whilst past performance is not indicative of future results, history has proven that markets are remarkably quick at absorbing shocks. A study by Deutsche Bank showed that markets typically digest geopolitical shocks within 3 weeks. This aligns with our own analysis, which examined 40 major geopolitical events from the last 85 years. We looked at the market impact of these events over 1 month, 3 months, 6 months, and 1 year, and found no consistent evidence that these had a lasting impact over these periods. As you can see on the graph, the average returns of the S&P 500 tend to be positive over both the short and long term, even after these events. Because markets are influenced by a complex web of factors, sometimes an unexpected variable can derail even the most well-thought-out investment strategy. Hindsight often brings clarity, but foresight is rarely so simple. Let's take the Brexit referendum in 2016 as a great example. Most investors didn't anticipate a leave vote, but even those who correctly predicted Brexit were wrong about how markets would react. The prevailing expectation was that UK equities would suffer. Instead, the market responded very differently. What many underestimated was the sharp drop in the British pound. This currency depreciation actually acted as a positive feedback loop for UK equities, particularly for companies with significant overseas earnings. The weaker pound made UK exports more competitive, boosting the value of foreign revenues when converted back into sterling, ultimately supporting the UK market. Trying to time market entries and exits as a reaction to news is notoriously difficult, and in most cases nigh on impossible, even for seasoned investment professionals. Markets are influenced by countless variables, many of which are unpredictable. Missing just a few of the best performing days can significantly reduce your long-term returns. In fact, calculations from Vanguard, an international fund manager, suggest that missing the 10 best performing days between 1994 and 2024 could have resulted in 45% lower returns than if an investor had stayed in the market for every day. If you missed the 30 best days during the same period, it could have resulted in 75% less returns. Staying invested through volatility allows compounding to work in your favour. Over time, markets tend to reward patience and discipline. So the key takeaway from this video is that the longer you remain invested, the more you benefit from recovery periods, dividend reinvestment, and growth. Thanks for watching. If you have any questions about today's video, please get in touch. Just email hello@fcadvice.co.uk. Finally, as always, I've been talking about investing, which means your capital is at risk.